Welcome to my video, The Shrinking Money Supply and the Case for Gold. The US money stock M2, defined as US dollar cash in circulation plus consumers and producers' US dollar deposits held with US commercial banks, is shrinking. In April 2023, it declined 4.7% against last year. Why is it happening? And even more important, what does it mean for precious metal investors? Answers to these questions should be of great interest for those who think money matters. After looking at the data in more detail, we found that the decline in M2 can be attributed to basically three factors. Factor 1. People have been moving out of deposits included in M2 and into longer-term bank liabilities outside the definition of M2. This is presumably due to higher interest rates to be earned on bank bonds compared to bank deposits, and it results in a decline in M2. Factor 2. The Federal Reserve does reverse repurchase operations with privileged non-banks, such as, say, hedge funds and asset managers. The latter have the opportunity to exchange their excess cash holdings overnight against bonds held by the Fed. And as demand deposits held with commercial banks are transferred to the Fed, this also adds to the drop in the money stock M2. Factor 3. It may also be the case that US commercial banks sold part of their assets, in particular bonds and loans, to non-banks. In such a case, unfortunately, we lack the proper database. Banks' assets as well as liabilities in the form of destroyed demand deposits decline, also contributing to a fall in the money stock M2. Taken together, these three factors suggest that the amount of liquidity in the US economy in general has been falling strongly in recent months. In addition, the changes in money holdings make banks' refinancing more costly. If banks' returns on their asset portfolio remains unchanged, downward pressure on US lenders' profitability increases. It should be noted here that US bank credit expansion, the most important source of increases in M2, has slowed down considerably lately. This may be due to lower credit demand because of higher interest rates and slower economic growth, or to credit supply side restrictions as banks' lending standards have become tighter. But still, positive bank lending growth rates have added to, not subtracted from, the money stock M2. In fact, bank credit expansion is key for determining the long-term trend development of money stock M2. Should banks decide to stop lending, the inflow of new money into the economy would come to a standstill. And if banks call upon their customers to repay their loans, the money stock would start falling. This in turn would pave the way towards deflation, falling goods prices across the board, most likely accompanied by recession. How likely is such a scenario? Well, the chances that the Fed is over-tightening are certainly not zero. Just look at the monetary overhang calculated on the basis of US M2. The monetary overhang can be understood as the money created that has not yet been absorbed by higher goods prices and/or higher output. Starting in early 2020, the Fed had increased M2 massively by a total of roughly 40% at one point, causing an enormous monetary overhang. Meanwhile, however, the monetary overhang has been absorbed in great part as GDP growth came back and goods price inflation went up sky high. In Q1 2023, the monetary overhang was down to just 2.1%. If M2 keeps declining, the monetary overhang could all too easily turn negative. That is, exerting downward pressure on nominal GDP growth, most likely forcing the economy towards very subdued goods price inflation and/or sub-potential GDP growth, or a combination of the two. Needless to say that this would be an extreme challenge for the highly leveraged fiat money system. In fact, a deflationary process, once it gets going, could make the credit pyramid come crashing down. In this context, we need to remind ourselves that the Fed's interest rate hikes are not yet fully felt in the economic and financial system. This is because monetary policy works with time lags. That said, it is fair to assume that we will see further restrictive effects stemming from the rise in credit costs, which started in 2022. If it turns out eventually that the Fed has over-tightened already and a recessionary deflationary expectation sets in, things could become ugly quite easily. If monetary expansion stops and goes into reverse, the house of credit cards breaks down. The inflationary illusion of riches and affluence ends, and businesses and employment suffer badly. Murray Rothbard put it succinctly: as soon as credit expansion stops, then the piper must be paid, and the inevitable readjustments liquidate the unsound overinvestments of the boom, with the reassertion of a greater proportionate emphasis on consumers' goods production. It is fair to say that an approaching deflationary recessionary shock caused by a depressed money stock would very likely make central bank councils to fall over one another in an effort to ease monetary policy again by cutting interest rates, expanding central banks' balance sheets, sending liquidity without end into the banking system, and ramping up the stock of money in the hands of the private sector, as was practiced in 2020 and 2021 basically the world over. In such a situation, the expansion of money, that is, the creation of monetary inflation, will be seen as the policy of least evil, finding approval among the public at large, one has to fear. Indeed, while the probability of the fiat money system ending in deflation is certainly not zero, there are good reasons to believe that inflation is an even bigger risk for the investor in the current life cycle stage of the fiat money system, which may be compelled pretty soon to go against deflationary forces by returning to inflationary policies. It is against this backdrop that we recommend to hold at least a portion of one's liquid portfolio in physical gold and in part also in physical silver. These precious metals can be viewed as insurance against the rising economic and geopolitical risks that keep rising with prevalence of political efforts to prop up the worldwide fiat money system. So even the temporarily shrinking US money supply should not deter investors to demand physical gold. Quite the opposite. Thank you very much for your attention. If you enjoyed the video, please like and share it, ring the bell and follow my channel.